This is Chris Casey, Managing Director at WindRock Wealth Management. Today we have the pleasure of being joined by Jim Rickards, noted economist and financial commentator. He has authored a number of books, including his most recent, Aftermath, Seven Secrets of Wealth Preservation in the Coming Chaos, which came out just about 6 months ago. My personal favorite, Currency Wars, back from 2011. Mr. Rickards, thank you for joining us.
Great to be with you, Chris.
Now, do you think the financial market downturn we're experiencing right now is akin to the 2008 crisis, or do you think investors should be looking at something larger, such as the Great Depression, as a better comparison?
Yeah, you have to start with the Great Depression. Now, even that is different in important ways, but that's the right frame of reference. This will be much worse than 2008. Not. I mean, better, worse is not necessarily the right terminology. It'll be different, but yeah, the stock market will be down more. Unemployment will go higher, probably last longer. And 2008 was a very acute financial crisis. Now, it turned into a recession, a pretty bad one, but it was confined, at least initially, to the mortgage market, and then it spread out from there to banks and non-bank lenders and hedge funds and, companies like AIG, which was in the financial insurance business. So it took a lot to get it under control, but we knew where it was coming from. It started in the mortgage market and then spread through derivatives and banking generally. And you look at other crises. 1994, the tequila crisis, very specific to Mexico, et cetera. But this is different in the sense that it affects everything. I actually can't think of a sector that's not hurt by it. You don't go around and say, gee, where's the problem? The answer is the problem is everywhere. And in terms of how long it'll last, how much the stock market will go down, how high unemployment will go, it looks a lot more like 1929 than 2008. So that's the right starting place for understanding it.
A lot of people forget, at least with the 2008 Great Recession, that they actually dated to December of 2007, right? So it happened well before a lot of these various financial crises that occurred before people really felt the pain of the economic downturn. Do you think this current recession started before coronavirus? Could you date it back to the repo market blowing up, or even maybe in December of basically 18, when Mnuchin and the Federal Reserve were really panicking over the economy?
Well, to the extent that the specific catalyst was coronavirus, the answer is no. You'd really have to look to the December 2019, January 2020 timeframe for that. But things are never quite that simple. You can have something like a coronavirus pandemic come into a strong economy, or it can come into a weak economy. In this case, it came into a weak economy, and there, I do think it is relevant to look at some of the earlier events you mentioned, and I'll come back to those in a second. But as far as, for example, the 2008 crisis, you mentioned December 2007. Well, yeah, that's when the foreign sovereign wealth funds bailed out the banks the first time. They had to get bailed out again in September, October 2008. But you can go back even further than that. I mean, in June of 2007, you had the failure of those two Bear Stearns hedge funds. In August 2007, you had the famous Jim Cramer rant with Aaron Burnett on CNBC, where he's yelling at the Fed, they know nothing. And he was right about that. And the Fed responded then. But go back even further, if you were an insider and you were looking at mortgage payment information from the servicers or an investor's perspective, the alarm bells started going off in late 2006. And then in the spring of that's when the arrears, the late payments showed up. And then in the spring of 2007, HSBC announced that their earnings would not meet expectations because of mortgage losses, and then so on from there. So, yeah, the acute phase was September, October 2008. That's exactly right. But it started in late 2006, early 2007. It makes a point that these things can take a year or more, sometimes 2 years to play out. Same thing happened. People remember the 1998 panic when Russia defaulted in long-term capital management. The big hedge fund in Darien, Connecticut had to be bailed out by something led by the Federal Reserve. Yeah, that was September 1998. But that started in June 1997 in Thailand, when Thailand had huge capital outflows, and they had to put on capital controls and devalue the currency, and then spread around the world through Indonesia, South Korea, calmed down a little bit, and then came back strong. And the summer of 1998 with Russia and long-term capital management, and they finally built a firewall around Brazil. So in looking at those two crises, 1998 and 2008, it's easy to see that they both started over a year before it came to the attention of most investors. Well, the same thing here. Here we are in April 2020, and we're not in a recession. We're in a depression. So that's the right way to think about it. And yeah, you can trace the coronavirus back to December 2019, but you're right. In September 2019, we had a repo crisis. So clearly, there was stress in the system. Clearly, there was a shortage of liquidity and a bit of a dollar crisis as long ago as 6 months ago. And as far as the economy is concerned, this has been going on for 11 years. I mean, the last recession before the one we're in now was over in June 2009, but we had 11 years from June 2009 until early 2020, where average growth was 2.2% a year. Now that compares with the average for all recoveries since 1980 of 3.2%. So even in this so-called recovery, the growth was punk. I mean, growth, as I said, was 2.2%, which left $4 trillion of wealth on the table, $4 trillion of wealth that disappeared in the recovery. I'm not talking about the crisis. I'm talking about the recovery relative to trend growth of, more like 3.2%. So we were in a weak recovery to begin with. There was clearly a dollar crisis going back to September 2019, or if not earlier. So there were plenty of weakness, plenty of liquidity concerns before the coronavirus hit. So the point being, as you suggest, Chris, when it hit a weak economy, not a strong economy, and the result is far worse.
Yeah, and this CARES Act is pretty extraordinary, even compared to 2008 criteria, right? As far as what they did after that. How do you see this affecting the economy and financial markets? Do you really think it's going to be a stimulus? And do you think it will help the financial markets recover? Or do you see it more of a plugging a hole?
It's not a stimulus at all. I mean, people say we have a spending bill that gives stimulus. Well, I would say no, you have a spending bill that gives spending. There's no stimulus in this. I mean, look at what CARES is doing. It's $2.2 trillion for various purposes. They got $50 billion for the airline and $325 billion or so, maybe a little bit more for small business loans. So the money is being, put in a lot of different directions where it will help. I'm not against it, but don't call it stimulus because it's not. This is, even the approximately 325 or so billion of small business loans. And I know a lot of small business proprietors. I've spoken to all of them and say, hey, get your application in. The government's giving away money. This isn't welfare or charity. This is the government wants you to have the money. But if you read the details and read the limits on it, it's based on payroll and rent and a couple other things. It's kind of a 2-month bridge, maybe a bridge to nowhere. So yeah, it's a lot of money and the government wants you to have it and it will be helpful, but it basically covers your payroll and your rent and then some overhead for 2 months. Well, what are we going to do in June? In other words, this is like, I was in the Boy Scouts, and I was about 10 years old. I learned how to apply a tourniquet to someone who's bleeding to death. Well, that's a good skill, and it can stop the bleeding and save a life, but it doesn't mean the patient's well or back on her feet. I mean, so have they stopped the bleeding in a small way? Yes. But is this stimulus? Is this going to solve the problem? Not even close. And so my expectation would be that, again, we're in a depression. We're going to go straight down. But that doesn't mean we come straight back. There's no reason to think that we're going to get a so-called V-shaped recovery. The question I get asked most frequently, and I've done other interviews, and people ask the same question, which is, is the bottom in? Is this the bottom? Is this a good time to go buy stocks? Well, do what you want, but I'm not a investment advisor, but the bottom is not in. This is going to go a lot lower. I mean, between 1929 and 1932, during the worst part of the Great Depression, the Dow Jones Index fell 89%. Call it 90% for a number. That's what a bear market looks like. Between 2000 and 2001, the Nasdaq fell 67%. Again, that's what a bear market looks like. So now the stock market has fallen about 30%, give or take. That's a big hit, and it's a bear market. But you know, I would expect something like 60% or more before this is over. So I would say that the Dow Jones could go down to 12 or 14,000 before this is over.
Yeah, and people forget not only the severity of the Great Depression as far as the stock market decline, but they also forget how long it took to come back. I believe in real terms, it wasn't until like 1956 where you're even if you're at the highs of 29. Um, so that's how bad things can get for equities. What about bonds? Should Treasury still be considered a safe haven, given that that's where most liquidity is going?
Yeah, I mean, treasuries are a safe haven. Whenever you buy bonds, there are a number of different risks. People focus on market risk, but you also have credit risk, execution risk, inflation risk. It's a bundle of risks. But in treasury bonds, I wouldn't worry about the credit risk. I mean, no reason for the treasury ever to default. Working with the Fed, they can monetize the debt, so they're not going to default in that sense. And so, and you have a dollar, so it's not like a foreign currency. I think foreign investors have to worry about exchange rates, but U.S. investors who are dollar-based, you get a dollar-denominated bond, so you don't have any currency risk. And the execution is pretty straightforward. So it's very low risk. The risk in owning treasury debt is inflation. If you buy a bond or a note and it has a certain coupon, and it's a 10-year note, for example, or a 5-year note, and inflation takes off, then you could lose in real value. You're not going to lose in nominal value, but you could lose in real value. So that's your risk. But right now, the risk of inflation is pretty close to zero. I mean, the real risk is deflation, and deflation makes the real value of money and debt go up. So if you buy, of course, interest rates are rock bottom; they're pretty close to zero. But if you buy a treasury note and it's paying, almost no coupon, but it has a dollar denomination, and you get into deflation, your bond is actually more valuable because the value of dollars goes up in deflation. So that's just another way to make money. So yeah, I do consider that a safe haven.
Well, with all this economic chaos and the financial crisis, do you think this could really it's an existential threat to today's monetary system? Because in Currency Wars, your last chapter, it's a great chapter. It's entitled Endgame, Paper, Gold, or Chaos. You lay out various scenarios for a new monetary system. How do you see this playing out? And depending on how you see it playing out, what are the signs you're looking for to see if this is really imminent or going to happen?
Well, the best early warning, all markets try to discount the future. You don't, kind of drive into a brick wall. You try to figure out what's ahead and avoid it or take advantage of it, as the case may be. And stock markets do this. The problem the stock market's having right now, they're trying to discount a moving target. So the stock market's trying to figure out how bad will the pandemic get and how long will it last. And no one knows the answer to that, but you can make some kind of intelligent estimates, and then they're trying to trying to discount the impact of the depression. That's more difficult. I mean, the virus could be over, but the depression could linger for years. So that's a more difficult discounting challenge. But the market's trying to do that. Although again, when you discount to a moving target, you have to keep rediscounting because things keep getting worse. But beyond that, there's something the market hasn't even thought about. Because probably they're too busy with the things I just mentioned, which is President Biden. I mean, you have to make the election much more of a 50-50. I have very good predictive analytic models in politics as well as economics. And until, about 6 weeks ago, they had Trump with a 74% probability of winning, and one would expect that to go higher as Election Day approaches. Well, that's out the window right now. Based on everything that's happened, you have to reset that at 50-50, make it a toss-up. But so you can't just dismiss Biden. You have to give him, like I say, an even chance of being president. Well, what does that mean? Well, it means higher taxes, more regulation, Green New Deal. I don't debate politics. I mean, people can vote for whomever they want. I'm not here to tell people who to vote for, but I am here to say that the stock market has not discounted the impact of a Biden victory, and that could be another round of down markets, because I know stock markets, regardless of your politics, stock markets don't like higher taxes, regulation, and the excess deficits that will be caused by the Green New Deal on top of what we already have. So we have a long way to go here. But the best predictor, the one asset class that does the best job, looks furthest ahead, and is the most accurate. In fact, it looks so far ahead, it's kind of hard to tell what it's saying sometimes, is gold. The dollar price of gold, that's your canary in the coal mine. When you see that shooting up, which I do expect, that'll tell you that people are losing confidence in the dollar. They're losing confidence in the Federal Reserve. It can mean inflation, but it doesn't have to. I mean, people forget that the greatest period of sustained deflation in U.S. history, 1927 to 1933, gold went up 75%. So there we were in the middle of the Great Depression in a period of prolonged deflation, and gold went up 75%. People understand that gold goes up in inflation. That's kind of intuitive, but they don't understand that it goes up in deflation for other reasons. But even though we're going to be stuck in a serious and dangerous deflationary episode, at least for the time being, doesn't mean that gold won't go up, because it will still have this safe haven bid, and it will be looking ahead saying, well, at what point does the deflation turn into inflation because of government policy, and actually look through the deflation to something that the situation where the inflation comes roaring along behind it, which is exactly what happened in the 1970s, by the way. So gold's your canary in the gold mine. Watch the dollar price of gold, and that'll tell you more than any other asset class about what's coming next.
So in addition to gold, maybe some treasuries, investors should avoid stocks. What else should they look to, though? Are there any other asset classes you like, given the financial instability that you see coming down the pike?
Yeah, there are a couple. I like a lot of cash, and people hate cash because they say, well, it has no yield. Well, right now 10-year Treasury notes have no yield, or at least it's. I'm looking at a ticker; it's about 60 basis points, so well below 1%. So those lower nominal rates, and what I would expect would be even lower real rates in time if we get around to negative interest rates, et cetera, is very positive for gold, because if you think of gold competing with fixed income for investor dollars, the higher the nominal yield on the fixed income, the less attractive gold is. Well, the opposite is true. The lower the yield, the more attractive gold is, and that's the environment we're in right now. So, but I like cash because cash does well in deflation. If you have a dollar, and say you have a paper dollar and you stick it in a drawer, well, it's still a dollar. But if you have deflation, the dollar is more valuable. The real value of that dollar went up because prices went down. You get more for your dollar. Again, we haven't seen this since the 1930s, but that's how it works. So I like cash. The other thing about cash that people underestimate is it has huge embedded optionality, meaning if things are crashing all around, which they are at the moment, the person who has dollars, who has cash, in other words, can take a deep breath. You can step back, watch the action, so to speak, and pick your spots. If you're all in, if you're all in equities or you're all in private equity, or you're all in real estate or any other asset class, and you want to pivot, you say, well, gee, I'd rather be over here. Well, you have to get out of that asset class first. You have to sell your stuff to get the money to go over to the other asset class. I hear people all the time go, I have money in the stock market. I have money in the bond market. I have money in real estate. I say, no, you don't. You may have stocks, bonds, and real estate, but that's not money. Those are assets. If you want money, you have to sell them. Well, it's not a lot of fun selling assets when everyone else in the world is doing the same thing. But the person with cash doesn't have to worry about that. They can, as I say, they're making money if deflation takes hold, which I expect it will. But more to the point, they have liquidity, and if you actually do see a bottom in something, you're the one who can jump in while everyone else is still stuck in whatever they were doing before. So I would say treasury notes, gold, cash. That's a pretty attractive portfolio right now.
Well, that's great advice. How can people read more of your articles and check out your books?
Well, thank you. I've got a number of books. The most recent one you mentioned is called Aftermath. Came out last year, and it pretty much warned about exactly what we're going through right now. And not just a warning, because there are a lot of Chicken Littles out there, but it gave specific market vulnerabilities. I mentioned the word pandemic, but it's not like I predicted coronavirus. I didn't, but pandemic was on a list of things along with natural disaster, a war, pandemic, a political earthquake. There are a lot of things that could cause it, but I always say it's not the cause, it's the reaction. There's a long list of causes. You're never quite sure which one it will be, but the reaction is much more predictable because of things like passive investing, indexation, ETFs, robotic trading, risk parity strategies. I said all of those are going to come back to haunt the architects because they're all they work on the upside, but they amplify the losses on the downside, and they can be very hard to get out of. And of course, that's exactly what's happened. But it does have a number of strategies, and it's not too late to put them in place. Another one of my books, it was also a national bestseller, called The New Case for Gold. I like to say there are a lot of smart people out there. They're not uneducated, but they are miseducated. By that, I mean they were never taught gold. Gold has not been taught in any economics curriculum since the 1970s. So we just have, 2 generations of experts, not to mention everyday people, who are completely ignorant of gold, and they think it's kind of pretty and interesting, and maybe they're intrigued at this stage, but don't really understand gold's monetary role because they haven't been taught. But I was taught. I got my degree in international economics in 1974, and gold was still a big part of the international monetary system at the time. And my, I was a 25-year-old grad student, but I had 55-year-old professors. They were the young guns of Bretton Woods. Their heyday of their career was in the 1950s, and they put the Bretton Woods system in place. So I was being taught by the people who actually created that most recent version of the gold standard. So I internalized that. I took it with me, and I always understood it. But today, if you're in your 30s, 40s, or 50s, and if you know anything about gold, you either went to mining college or you're self-taught. Because the school stopped teaching a long time ago. But I have a book called The New Case for Gold, which blows up all the myths, explains how gold, the monetary role of gold, explains what it does, how it performs, how to get it, how it will come back. So Aftermath and The New Case for Gold are 2 of my books, but I have 5 altogether, and they've all been bestsellers, and they're all available on Amazon. Thank you.
Well, I definitely encourage everyone to check them out. Jim, thanks for your time today.
Thank you, Chris.